Yes, ma'am.
So, what is capital budgeting? Whenever a company wants to invest in high amount, when we need capital budgeting is a process, is a technique from which we take a decision of huge investment. So, it helps in decision making when there is involvement of huge capital, say 100 cr or 500 cr, which is really a very big amount in business world. Now, this is irreversible in nature. Irreversible, why? Irreversible in nature means if once we will take the decision, we can't go back. Example, if we want to buy a machine, like if we will talk about Reliance Industries. Reliance Industries want to set up a big plant for its geo telecommunication. Now for its now for starting the geo, definitely Reliance needs at least 500 crore or 1000 crore investment. So Reliance wants to buy a machine. I'm taking a small amount, which is 10 lakh. Machine cost 10 lakh. Now, once Reliance will buy that machine and install that machine, after 2 to 3 months, Reliance will think we should not buy this machine. We bought it by mistake. We should buy another machine. Now, it is not that simple. You will uninstall the machine and you will sell that machine and again you will buy the new one. It is not that easy because it is a big setup of plant. So, we have to take the decision carefully. Now, for taking the decision, we need to follow some methods, some techniques. How we will take the decision. So, techniques or methods, both are same. There
Uh,
are
Capital means money, ma'am.
capital, yes, money which we need to invest in the business for running of the business, for starting the business.
Okay.
Now, there are two techniques. One is traditional and one is modern. Traditional means when there is no concept of time value of money. What is time value of money? When we know if we will keep the money in our almirah and we will not invest that money, 100 rupees will remain 100 rupees after 5 years. And even that 100 rupees will decline and it will become 80 or 70. Why? Because due to passage of time, money's value will decrease. For example, if we will talk about 1000 rupees, in when our parents was young and they can buy many things for 1000 rupees. But if you will talk about 2023, we can spend 1000 in like 30 minutes or 40 minutes if we will go out, and in their times in from 1000 rupees they can run their house. So we can understand that time value of 1000 rupees is more and now the value of 1000 rupees is less. What is the meaning of value? It means purchasing power. We can buy so many things at rupees 1000 30 years before, but now our purchasing power has been declined. From 1000 rupees we can't buy, like we can buy only few things. So time value of money says money's value decreases by time due to inflation. Why purchasing power decreases? Because inflation is there. So traditional method does not consider the concept of time value of money. It does not consider time value of money. But in modern techniques, they have considered this concept. So what is traditional methods? Traditional methods are payback period. What is payback period? We will discuss. First, I'm writing all the methods. Payback period method, ARR method, and here NPV method, IRR method, discounted payback period method. Now we will discuss this one by one. What is payback period method?
Ma'am,
Payback.
can you explain only modern methods, ma'am? What is the meaning and its advantage, disadvantage for
Okay, you
this?
don't want to go into traditional.
No, ma'am.
So what is NPV? NPV means net present value. Can you tell me its formula?
No, ma'am. I don't have idea on modern methods.
Present value of inflow minus present value of outflow, which in short we can say NPV is equal to PVOI minus PV. Okay, fourth method is PI. So PVOO. This is the only formula of NPV. Now, what is NPV? NPV means first you need to understand what is present value of inflow. What is present value? Present value means, say, if you will borrow 1000 rupees from me now, I have given you 1000 rupees. And after 5 years, if you will return 1000 rupees only, then I can't buy, if say nowadays at 200 rupees we can buy a burger. So
Yes.
you have taken 200 rupees from me and you have bought one burger. Now after 5 years, if you will return that 200 rupees only, then that burger cost 300 rupees and you have returned me 200. So I can't buy that one burger after 5 years because due to inflation that burger cost 300. So my purchasing power has been declined. For that reason, we charge interest. That's why there is a concept of interest. So what you will do? Because of interest, we can't increase our money. If you have 200 rupees and if you don't want to buy a burger today, you have kept that money in your saving account in the bank. And after 1 year, if you will withdraw that 200 with interest, that is 300, that after 1 year also you can buy only one burger. So now if you will buy the burger, you can buy only one burger at 200 rupees. After 1 year, if you want to buy that burger only, then you can buy at 300 rupees that burger only. It means banks has saved your purchasing power. Because of saving account, your money will not increase. You can't say if you will keep the money in bank in saving account, your money will increase. It means your money will not increase. Your purchasing power will be constant. So this, so what is the concept of present value? If you have, like, I have come to you and I will explain you. There is a machine. There is a machine that costs 10 lakh rupees, and if you will buy this machine from me, its life is 5 years. After 5 years, this machine will not work anymore, and it will give you cash flow. In the first year 2 lakh, in the second year 2 lakh 50,000, in the third year 3 lakh 50,000, then 5 lakh, then 6 lakh. Now this cash flow I am telling you today at the time of selling the machine, and this cash flow we will get at the end of the every year. Means year, this is 23. Now I am telling you, you will get in December 2 lakh. In 2024, you will get 2,50,000. In 2025, you will get this. In 26 and 27. But this 2,50,000 will not be 2,50,000 at the end of 2024. It will definitely decreases. So what you will do, you have to decrease it according to inflation index. Now, what is DF? DF is discounting factor.
Ma'am, can you explain what does NPV resembles? Like how it is helping for capital budgeting, ma'am? I don't want problem
That
things.
I am telling you. You know present value of inflow, then I will escape.
Yes, ma'am.
So tell me first, what is DF?
Discounted factor, for example, first year, second year, third year, fourth year. If we are in, like, if we want to find the future value, we will be doing compounding. But if we are in fourth year and if we want to find the first year present value, then we will be discounting. So the discounting, whatever the discounting we will be doing, that will be known as discounting factor.
That means money value will decrease.
Yes, ma'am.
So from where you will get your present value of inflow?
Sorry, ma'am.
From after discounting, that discounting cash flow is after totaling this is your present value of inflow,
Yes, ma'am.
right?
Yes,
So
ma'am.
you are how you will take the decision. Do you know the decision making criteria?
No, ma'am.
How we use NPV? We need to know what is the decision making criteria. If NPV is positive, then we will buy the machine. If NPV is negative, then accept the project. If NPV is negative, then we will reject the project. Means we will not buy that machine. So whenever someone will come to us and will explain we like their machine, should we buy or not? For that we calculate NPV. NPV means in the total 5 years we will get this much of amount. Say we will get 12 lakh. After totaling this we will get 12 lakh. Means if inflation will be there and if we have discounted this amount, we will get 12 lakh at the end of 5 years. And we have spent 10 lakh now because this machine cost 10 lakh. So we will ultimately save 2 lakh. So we will buy this machine because NPV is positive. So from NPV, we can take the decision whether we should buy the machine or not. If NPV is positive, we will buy the machine. If the NPV is negative, we will not buy that machine.
Okay.
Any more question from NPV?
No, ma'am. Like NPV is the best method or
NPV is the best method.
okay.
Okay. Now the second thing is PI. PI is the another PI means profitability index.
Hmm.
PI means present value of inflow divided by present value of outflow. Now, what is its decision making criteria? Can I change the page?
Yes, ma'am.
If PI is greater than 1, we will accept the project. Means we will buy the project machine. If PI is less than 1, we will reject the project. So we will calculate PI. If we will calculate PI from this information only, 12 lakh and 10 lakh. So our PI would be present value of inflow is 12 lakh, present value of outflow is 10 lakh. So we have 1.2. 1.2 is greater than 1, so we will buy the machine. Now, why we do PI? PI is the index, profitability index. It means always NPV and PI will give the same result. Both will never contradict each other. If NPV is saying accept the project, PI will always say accept the project. If NPV suggests reject the project, PI will also suggest reject the project. Why we do that? Why we do PI then? Just because of the confirmation that NPV we have taken the right decision. If both are contradicting each other, there may be any fault, any mistake from our side. And one more thing, what is this PI? PI means if we will invest 1 rupee, we will get 1.2 back. So it
Okay.
means what is PI? If we will invest 1 rupees, we will get the profit of 0.2. Means we will get 1.2 back. 1 is the capital which we have invested, extra is 0.2, so this is our profit. So
Okay.
20% is approx our profit. If we will invest whatever we will invest, 20% is our profit.
Mhm.
So on the basis of inflow only, it does not contain interest, it does not contain tax, it does not contain any other factor, only contains inflow. So on the basis of inflow, our profit is 20%. So PI says only this much.
Okay,
Any
ma'am.
doubt from PI?
No, ma'am. What is the disadvantage in PI, ma'am?
No disadvantage.
Okay.
PI and NPV are the best methods, but we consider NPV as the best, and PI also, like PI follows NPV. Whatever NPV says, so PI also says that. So PI has no default disadvantage. What is IRR? IRR means internal rate of return. Now, what is internal rate of return? See, we have some cost of capital that we have studied in cost of capital chapter.
Yes,
Cost of capital, you know, right?
yes, ma'am.
What is cost of capital?
Cost of capital means in order to raise the capital, we need some debt and equity. So the cost of capital, which collides the cost of debt plus cost of equity, is known as cost of capital.
What is that cost?
Uh, which cost, ma'am?
What is the cost of equity?
Raising of funds, shareholders thing.
No, cost of equity. Cost means expense, right?
Yes, ma'am.
So what is cost of equity?
I don't know, ma'am.
Cost
Exactly.
of equity means equity dividend.
Okay.
If we will, as a company, if we will issue the shares, we need to pay dividend to the shareholders.
Yes, ma'am.
Again, equity dividend is not compulsory that you need to pay. You have to pay. It is not like this. But generally, every company pays dividend. Otherwise, shareholder will lose interest in your company. So generally, every company has to give dividend. So if company will give equity dividend, this is the cost of equity. This is the expense of issuing equity. What is the cost of debt?
Interest rate for loans.
Interest. And what is cost of preference share?
Dividend only, ma'am.
Preference dividend. And what is the cost of term loan? Again, interest.
Okay. What is the
So,
difference between loan and term loan, ma'am?
nothing. This is the full, like, more specified word, more
Okay.
uh, good word.
Okay, ma'am.
In FM, they don't, loan is the word of accountancy, term loan is the word of financial management. So,
Okay.
whenever any financial manager talk about these things, they always use term loan. But any accountancy person talks about loan, they always says loan.
Okay.
So the thing is, so what is IRR? IRR means IRR has some decision making criteria. First, you need to understand this decision making criteria. If IRR is greater than cost of capital, we accept the project. And if IRR is less than cost of capital, we reject the project. What does this mean? It means cost of capital means you have to earn that much. What is your cost of, like if you have to pay 2 rupees dividend, 3 rupees interest, 4 rupees preference dividend, and 5 rupees this. So 9, 10, 11, 12, 13, 14. 14 rupees we need to earn. Whatever will happen, we have to pay this 14 rupees to the providers, fund providers. We need to pay 14 rupees. So at least 14 rupees we need to earn. That is cost of capital. Now, our return should be more than cost of capital. If we will earn only 14 rupees and we have to pay 14 rupees, then nothing will be left. So we need to earn more than this 14, at least 15 rupees, so that we can save 1 rupees as our return.
Yes, ma'am.
So if internal rate of return is greater than cost of capital, we accept the project. If internal rate of return is less than cost of capital, we will not buy that project because it leads to loss. We can't recover our cost of capital from that machine, from that project. So we will reject that project. Now we understood why we calculate IRR, because to take the decision
Yes,
by
ma'am.
comparing it from cost of capital. Now, what is IRR? IRR means where NPV is 0. Means at NPV, at NPV 0, that point is called IRR. Now, what does this mean? Hmm. So first we need to understand what is the advantage of NPV, why we do NPV. So the most important advantage of this is it considers the concept of time value of money. So consider the concept of time value of money. This is the most important advantage why we use NPV. Second thing is, second is the thing, NPV uses discounted cash flow concept, so that we can calculate everything in terms of current terms of rupees, current rupees. What is the valuation of current rupees? So actually NPV has only two concepts. It considers the concept of time value of money, and why we calculate NPV, we use always discounted cash flow concept, means present value of the inflow. This is the only advantage. But what is the disadvantage? As such, there is no disadvantage. But if anyone can ask that what is the disadvantage, if so, you can say accuracy of NPV depends on accurate estimation of, like I'm writing, accuracy of NPV depends on accurate estimation of two factors. Means if you are taking the decision whether we should buy the machine or not, we are using NPV method, and so NPV should be accurate. The decision from NPV should be correct. Now this NPV accuracy depends on two factors. First thing, initial outflow should be perfectly calculated. Means there is a calculation for outflow. Means the, see what is outflow. Outflow does not mean the machine costs 10 lakh, then that is the outflow only. If you have bought a AC, that AC cost, means you have purchased it from 50,000. When you have bought that AC, you need to install it. For that installation you have spent 2,000, and for loading and unloading of AC you have spent 3,000. So total AC's outflow is 55,000 and not 50,000. But many person does not have this information. They always say AC cost 50,000, so outflow is 50,000. No, outflow is the price which you need to take for the AC is to make the AC useful. You have spent that much of money, you have to take all the amount. Like only buying the AC does not make it useful for you. For making it useful, you have to spend loading, unloading charges and installation. So you have to calculate correct initial outflow and correct inflow. Inflow. You have to take two factors accurately. So basically, they firstly if we are going to an interview and they are asking any disadvantage of NPV, we will start. There is the NPV is the best method, and as such, there is no disadvantage of NPV because this is the best method and it is flawless. But if you have asked me, then I will say accuracy of NPV depends on accurate estimation of two factors, that is inflow and outflow. So this should be calculated wisely. If we have failed to calculate these two things wisely, then our NPV will give incorrect result.
Don't know, ma'am.
Okay, they can ask with any name. So PI, another name is desirability factor.
Okay.
So if they will ask the question from desirability factor, then we should know this is the PI. And what is its another name? Present value index.
Hmm.
So it has, and actually one more question, one more name, benefit factor index. It has this much of names.
Okay.
Now, advantage of PI. What is the advantage of PI? Why we use PI? First thing is, again, the same reason is it considers time value of money. This is the same. But especially for PI, we can say it measures, like we can rank the project on the basis of PI. We can rank the project. Means if we want to buy the machine. Now there are we like seller has like five different sellers has approached us. Like you can buy my machine. That seller is also saying you can buy my machine. Now how will you decide which machine you should buy? You have five options. Now how will you buy? See, there is a project A, B, and C. You have PI 1.2, 0.83, and 1.5. So B you will clearly reject. Why? B you will clearly reject. Why? Hello.
Yes, ma'am. Because it has less profitability index.
If they will ask you why you are rejecting B, then what will be your answer?
Because it has less profitability index.
No. Then we should accept this. We will not reject this one also. Why we are rejecting this? We are not giving the rank also. We will give rank 1 it and 2 to this. Why we are not giving rank 3 to this? We are simply rejecting this. Why? We should give rank at least 3, but we are not giving rank. We are simply rejecting it. Why?
Because from one first project to third project, there is a lot of difference.
No, these all answers are wrong. Answer is because in decision making criteria, it is clearly mentioned PI is less than 1. If PI is less than 1, we should reject the project. We will not think about that project once.
Yes, ma'am.
So we will simply reject this project because it is less than 1.
Mm.
And PI does not consider that project which is less than 1. Now, B is not simply not in our discussion. We have to discuss about A and C. Now, we will definitely, if we need to buy, we will buy this one because it has highest ranking. So PI answers always on the basis of rank. Okay. Now, why we can say like this only without giving the rank? You will say we will buy this one, but PI has one more use in capital rationing. Do you have any idea about capital rationing?
No, ma'am.
Okay. So where we can, why we are giving the rank? We can simply see 1.5 is the highest PI. We can select that one. What is the need of rank? Because there is a concept of capital rationing. Now, what is capital rationing? Ration means a limit. Capital rationing means we have limited capital. We don't have so many capital that we can buy anything. Like this would be clearly mentioned if you have limited capital. If we have limited capital of rupees 10 lakh only, we have 10 lakh only, and we want to open a cyber cafe. So we need to buy so many computers. Now, project, we have 5 projects option. We can buy 5 computers. Now, different computer have different price. Like it cost 2 lakh. It cost again 2 lakh 50,000. I'm taking the old numbers only, which I have taken in cash flow. 3 lakh 50,000, 5 lakh and 6 lakh. Now we can't buy all of them. Why? Because we have only 10 lakh. We have limited capital. Now how we will take the decision? Which one should we buy? You will say, ma'am, you can find NPV. I will say, okay. But NPV is, in this case, I am telling you. If we will talk about NPV, then its NPV is 45,000. Its NPV 49,000. Its NPV 30,000. It's 25,000. And it's 55,000. Now the thing is, NPV says positive NPV. If NPV is positive, accept the project. Now all NPV are saying accept the project. So we can accept all the project, but we don't have capital. We have limited capital. If we will find PI, it is saying 1.2, it is 1.5, it is 1.3, it is highest, it is lowest, and then it is 1.1, and then it is 1.8. Okay, PI is also saying all PI are also greater than 1. PI also suggests buy all the machine. But again, we don't have that much of capital. For that need, we will go for rank. Now, on the basis of what thing we will give the rank? On the basis of NPV or on the basis of PI? We will give the rank on the basis of PI. So we will give the highest rank to this, second rank to this, third rank to this, fourth rank to this, and fifth rank to this. Now we, according to the ranking, we will buy the project. Now in capital rationing, there is two concept. In capital rationing, there is a two concept.